In 2026, most people lose money in trading not because strategies don't work, but because they follow outdated advice from 2015 or blindly copy signals without understanding market behavior. The truth is, the markets have evolved. Algorithms, AI-driven trading bots, high-frequency trading, and global news flow now move prices faster than ever before. So if you're still relying on random indicators or guessing tops and bottoms, you're already behind. In this video, I'm going to break down the top 5 trading strategies that actually work in 2026, strategies used by profitable traders across stocks, crypto, and Forex. And the best part is, all of them can be applied even if you're a beginner. Let's start with the first and most powerful strategy, trend following with smart confirmation. This strategy is simple in theory, but extremely effective in practice because it aligns you with the strongest force in the market, momentum. The basic rule is this: don't fight the trend, trade with it. In 2026, trends are even more important because institutional money, hedge funds, and AI systems create long, strong directional moves that can last for weeks or even months. Your job as a retail trader is not to predict the future, but to ride these moves as long as possible. Here's how it works in a practical way. First, you identify the trend on a higher time frame, like the daily or 4-hour chart. If price is making higher highs and higher lows, the market is in an uptrend. If it's making lower highs and lower lows, it's in a downtrend. Now, instead of entering randomly, you wait for pullbacks. In an uptrend, you only look for buying opportunities when price pulls back to key levels, like the 20 or 50 moving average, or a strong support zone. In a downtrend, you only look for selling opportunities near resistance. But in 2026, just using moving averages is not enough. Smart traders use confirmation. That means before entering a trade, you wait for extra signals that the trend is about to continue. This could be a bullish candlestick pattern, like a strong engulfing candle, increased volume, or momentum indicators like RSI staying above 40 in an uptrend or below 60 in a downtrend. These small confirmations filter out bad trades and dramatically increase your win rate. The real power of trend following is not in how often you trade, but in how much you make when you're right. Most beginners take small profits and big losses. Professional trend traders do the opposite. They take small losses and let their winners run. In 2026, with markets moving fast due to AI and global events, one strong trend trade can outperform 10 random scalps. That's why trend following remains one of the most profitable and timeless strategies in the world, and it's the foundation of almost every successful trading system today. The second strategy that actually works in 2026 is breakout trading, but not the way most people do it. Most beginners try to trade every breakout they see and end up getting trapped in fake moves. In modern markets, fake breakouts are extremely common because smart money uses them to trap retail traders. That's why the key to breakout trading in 2026 is volume and structure, not just lines on a chart. A real breakout happens when price escapes a strong consolidation zone with high volume and strong momentum. This consolidation could be a range, a triangle, or a tight channel where price has been stuck for a long time. The longer the market stays in this zone, the more powerful the breakout becomes. Think of it like compressing a spring. The more you compress it, the harder it explodes when it's released. The mistake most traders make is entering the trade the moment price touches the resistance or support line. Instead, professional traders wait for a candle to close clearly above resistance or below support, and then check volume. If volume is higher than average, it means institutions and algorithms are involved, and that's what you want. Without volume, a breakout is just noise. In 2026, breakout traders also use retest confirmation. That means after the breakout, they wait for price to come back and test the old resistance as new support, or old support is new resistance. If the level holds and price starts moving again in the breakout direction, that's the highest probability entry. This single rule alone eliminates more than half of bad trades. Breakout trading works especially well during news-driven markets. Economic data, interest rate decisions, earnings reports, or major crypto announcements often create massive breakouts with strong follow-through. Instead of guessing the direction, you let the market reveal it, and then you simply join the move. This makes breakout trading one of the most stress-free strategies because you're reacting to confirmed price action, not predicting anything. The goal with with breakout trading is not to catch the exact bottom or top. The goal is to enter when the market has already shown its hand and is ready to trend. In fast-moving 2026 markets, catching the middle of a strong move is more than enough to build consistent profits over time. The third strategy that works extremely well in 2026 is mean reversion, but only when it's used with institutional levels. Mean reversion is based on a simple idea. Price does not move in one direction forever. After a strong move, the market usually pulls back to a fair value before continuing. The problem is, most traders try to use mean reversion in random places and end up trading against strong trends. That's why the modern version of this strategy focuses on key levels where big players actually place their orders. In 2026, institutions don't trade based on emotions. They trade based on liquidity zones. These are areas on the chart where a lot of buying and selling previously happened, like strong support and resistance, previous day highs and lows, weekly levels, and major psychological prices like 1.2000 in Forex or 100, 500, and 1,000 in stocks and crypto. When price moves too far away from these zones too quickly, it often snaps back because that's where real volume exists. Here's how you apply this strategy. First, you identify a strong impulsive move, either up or down. Then you mark the nearest institutional level below or above price. Instead of chasing the move, you wait patiently for price to return to that level. When it does, you look for rejection signs like long wicks, slowing momentum, or divergence on indicators like RSI or MACD. These signals tell you that the market is losing strength and is likely to revert back. This strategy works especially well in range-bound and choppy markets, which are very common in 2026 because algorithms constantly create short-term inefficiencies, while trend followers struggle in sideways markets. Mean reversion traders thrive because they profit from overextended moves. The key is discipline. You only trade at high-quality levels, and you never force trades in the middle of nowhere. Professional traders love mean reversion because it offers tight stop losses and high reward-to-risk ratios. You might risk $1 to make 3 or 4 simply by waiting for price to return to value. Over time, this creates a powerful edge, especially when combined with strong risk management and patience. The fourth strategy that actually works in 2026 is algorithmic scalping, but not in the way most people think. Traditional scalping involved sitting in front of a screen for hours, staring at candles and trying to catch tiny moves manually. In 2026, this has evolved. AI-enhanced signals and algorithmic tools allow traders to scalp small, consistent profits with much higher accuracy and less emotional stress. The concept is simple. You target small price movements multiple times per day instead of trying to catch big trends. The difference now is that AI can analyze hundreds of micro signals in real time, combining price action, order book data, and news sentiment to tell you when a high probability micro move is likely to occur. For example, an AI signal might indicate that a particular stock or crypto will likely move 0.5 to 1% in the next 10 to 15 minutes. That's your scalping opportunity. The key to success with AI scalping is timing and risk management. You never hold a trade for long. Every scalp has a strict stop loss and take profit. Modern scalpers in 2026 focus on high liquidity assets because spreads are low, and AI helps them avoid false signals in low volume markets. Many traders also use automated execution, meaning the AI places the trade for them once all conditions are met, removing human error and emotional hesitation. Another advantage of this strategy is adaptability. Markets in 2026 move fast due to high-frequency trading and global news, and AI allows scalpers to adjust in milliseconds. If volatility spikes or liquidity shifts, the AI either cancels the trade or recalculates the best entry and exit point, something a human can't do reliably. This creates an edge that was impossible to achieve just a few years ago. The beauty of AI scalping is that while each trade might make only a tiny profit, multiple trades per day compound into a significant income. Traders who master this strategy don't rely on guessing market direction. They rely on data-driven, pre-validated micro moves. For anyone serious about trading in 2026, learning to integrate AI-enhanced scalping is no longer optional. It's becoming a requirement for consistent profitability. The fifth and final strategy that works in 2026 is position trading with macro trend analysis. Unlike day trading or scalping, position trading is all about taking a long-term perspective and riding major market moves that can last weeks, months, or even years. This strategy works because at the macro level, markets move in predictable cycles driven by interest rates, inflation, economic growth, corporate earnings, and global events. If you can understand these big picture forces, you can align your trades with the strongest trends and avoid the noise of daily volatility. Here's how it works. First, you study macroeconomic data and market cycles. For example, if inflation is rising and central banks are tightening, certain sectors like technology might underperform, while commodities and energy stocks could thrive. If interest rates are dropping and economies are growing, growth and consumer discretionary sectors often see sustained rallies. By analyzing these trends, you're essentially trading with the smart money, not against it. Next, you identify key entry points using higher time frames, daily, weekly, or even monthly charts. Look for areas where price aligns with macro trends, such as long-term support levels, breakout points, or retracements to major moving averages. Unlike short-term strategies, you can tolerate small pullbacks because your edge comes from holding positions in the direction of the macro trend over weeks or months. Risk management is critical here. Position traders in 2026 often use staggered entries and scaling techniques, entering gradually as price confirms the trend and adjusting stops to lock in profits. This reduces emotional stress and avoids getting stopped out by short-term volatility, which is increasingly common due to algorithmic trading and high-frequency moves. Position trading also allows compounding gains. A single, well-researched trade in alignment with macro trends can outperform dozens of day trades because you're capturing the full force of a sustained market move. In 2026, this strategy works exceptionally well in stocks, crypto, commodities, and even Forex because macro forces drive long-term trends across all markets. For traders willing to combine patience, research, and disciplined risk management, position trading remains one of the most reliable ways to achieve consistent profitability year after year. With these 5 strategies, trend following, breakout trading, mean reversion, AI-enhanced scalping, and position trading, you now have a complete blueprint for trading successfully in 2026. Each strategy works in different market conditions, so understanding when and how to apply them is the real key to long-term success.